Is it really possible for individual investors to make stock picks that beat the market? What advantages over Wall Street do individual investors even have? Well, in legendary investor Peter Lynch's book, One Up on Wall Street, I found the answers to these questions and more. Welcome back to the Investors Podcast YouTube series, where we review the greatest books for business and life that have shaped our learning over the years. Hi, I'm Shawn, and this channel is all about the principles of investing. From stock tips to iconic billionaires, the best strategies, and our favorite tools, the Investors Podcast has everything you need to know. So let's get started. Peter Lynch was born in 1944, and he's most famous for managing the Magellan Fund, which generated a stunning 29.2% annual return over a 20-year period. That was more than enough to secure his place in the Wall Street Hall of Fame, and he not only considerably beat the market's performance, but he did so with remarkable consistency. So it's safe to say he knows a thing or two about investing, which is why I was so excited to read this book. One Up on Wall Street was actually one of the very first books I read when I started investing. Lynch's writing style is informative, and he doesn't make stock picking more complicated than it needs to be. That said, this book probably doesn't provide enough detail for brand new investors to run out and begin buying stocks after reading it the first time, though it's an excellent starting place and will provide learnings for investors of all backgrounds. Contrary to popular myth, nobody is born with a knack for stock investing. It's not something that's in our genes, and many people distrust the market, and Lynch's family was actually no exception. However, after a summer job caddying at a golf course as a kid, Lynch would frequently hear golfers discussing the opportunities to make money in the stock market, and his interest was piqued. Soon enough, he had enough money saved to buy his first stock, and after quickly and luckily making a profit, he realized this was a game he wanted to master. Lynch explains that there's a lot of gatekeeping around the world of investing by so-called professional investors, but in reality, such a term is an oxymoron. Anyone can be an investor, and research has frequently shown that just because you're a quote-unquote professional doesn't mean you're destined to perform better than everyone else. Plenty of people over the years have achieved spectacular returns without even a business degree. For most investors, there's a legitimate question as to how they should balance owning stocks with buying bonds. This debate has raged for years, and it really boils down to your personal financial goals and strategy. As Lynch points out, though, history has been pretty unequivocal. Stocks have outperformed bonds by a huge margin since 1927. Despite market crashes, recessions, depressions, wars, and everything else in between, the US stock market has proven remarkably resilient. In stock investing, you have an ownership share, which, in a sense, makes you partnered with that company. As their business grows, so does the value of your investment. But with bonds, there's not the same upside. Your cash flow payments are fixed, and the price of a bond is typically relatively stable. Lynch suggests before even exploring stocks and bonds, many investors should first consider whether they own a house. This has proven to be a far safer method of wealth building with decent profits in his opinion, and the risk of total loss is essentially zero. Building on this, all investors must ask themselves just how much they can afford to invest. Participating in the stock market should probably not come before paying off urgent debts or financing other important personal affairs. And lastly, for those wishing to pick stocks rather than just investing through passive index funds, these investors must look in the mirror honestly and ask themselves whether they have the persistence, patience, and detachment, among other necessary traits, to effectively invest in stocks. Assuming you're still interested in investing, which hopefully you are, there are a few other things to know. If it were possible to make money in the stock market by predicting the future, well, we all would have already lost money to those who are able to do so. The stock market and the general economy do move hand in hand sometimes, but it's not possible to make accurate predictions consistently given the huge complexities underlying these two areas. Anyone who claims to be able to make these predictions is at best engaging in pseudoscience and is at worst a charlatan. Lynch says that instead of trying to predict the market, an average investor should focus only on profitable companies that aren't overpriced. And in doing so, we may actually find that we have a number of advantages over the pros. We are consumers participating in the real economy, so as we go about our daily lives, we're sure to encounter trends that bode well for our investing prospects. Perhaps we find a new product of superior quality while shopping, or maybe we notice that our friends are all purchasing a new popular service or subscription. Paying attention to these sorts of things can tip us off that a company is likely to soon report excellent earnings, which most of Wall Street may not be aware of until the actual quarterly earnings reports come out. In this sense, just by paying attention to the companies you engage with in your personal life, you may uncover trends still unknown to those sitting in an office all day reading financial statements. Many average investors may jump the gun here, Lynch cautions, as just because you get a tip doesn't necessarily mean the stock is actually a good buy. Buying stocks without doing any fundamental research is like playing poker without even looking at the cards. That being said, it always looks wise to invest in big companies like Coca-Cola or Apple to get maximum profits. However, it's not for people looking to double or triple their stock prices in a short period of time. While big companies are great, it's best to take a look at small companies if you want to try to make more money. Lynch writes that when looking for perfect stocks, there are a few more things to consider. Firstly, notice the name. Is it dull and boring, like, say, Pep Boys? And secondly, does it do something equally boring? The more boring, the better. And yes, it sounds ridiculous, but you have an edge if you buy stocks in such companies because they go up even before anyone notices. Thirdly, if the company produces something that's not all that interesting, it's a big plus again. If there's any stock you need to avoid, then it's the hot stocks that everyone's talking about. For instance, when the internet bubble boomed in the late 1990s, just about everybody invested in these businesses. But many of them were doomed for failure from the beginning and people lost huge amounts of money. The problem with hot stocks is that they have too many competitors too soon and they go out of business even sooner. Additionally, their prices may decline rapidly without giving you a chance to sell. Just look at how volatile GameStop and Tesla are. The best way to know whether to buy a company, says Lynch, is to evaluate its earnings. He reminds us that stocks are not lottery tickets, but rather ownership, shares, and real businesses that produce earnings, which is just a fancy word for profits. If a company's earnings drop off or even just don't match investors' expectations for growth, well, the stock is going to drop. He suggests further that for our stock picks, we need to have clear reasons for purchasing, which he calls the 2-minute drill. Basically, what new factors are going to drive earnings? Are they launching a new product you expect to be successful? In doing our analysis, we ought to keep in mind how impactful our 2-minute drill factors can actually be. The sales percentage should tell us this though. If a product only accounts for 2% of the company's total revenue, for example, then even a 10% increase in sales for this product is not likely to make a meaningful difference to the stock's total earnings. Along with this, we should also review the price to earnings ratio, which is the price per share divided by the earnings per share. You'll want to check out that this value doesn't vary significantly from its industry peers. For this metric, the ratio should be proportional to the company's expected growth rate, and higher growth rates will merit a higher price to earnings ratio. Thirdly, Lynch suggests that investors review a company's cash position. In other words, how much cash do they have on their balance sheet with respect to their debt payments? Lastly, check the institutional ownership percentage. The higher this value is, the more well-known it is to Wall Street, which means the chances of extreme profits for you are probably reduced. After some time dabbling with picking stocks, Lynch highlights that you should compare your performance against the S&P 500s over the same period. And if you're underperforming, then you should just use index funds. You'll earn average returns without all of the headaches. In terms of managing your portfolio, well, you'll never find the perfect time to buy or sell a stock, but there are some times that are better than others. For example, from October to December, some investors may sell their stocks tactically to secure losses which they hope to use to offset other tax burdens. This can create buying opportunities for you. And periodically, the stock market will have 10 to 20% corrections, so these also make for great opportunities to buy more shares of stock. Don't ever delude yourself into thinking, though, that stocks can't possibly go lower. Oftentimes, stocks will go down and up far more than what most believe is possible. Even professionals fall prey to rumors, and just because they say stocks can't go lower, the truth is that they surely can. This is why stock investing is dangerous and you should proceed with caution. Additionally, Lynch leaves us with his thoughts that individual investors shouldn't waste time dabbling with options, futures, or short positions. These are essentially just ways to make additional side bets that will probably serve as a distraction. This doesn't mean that they're useless, but for most of us, the added benefits don't outweigh the cons. To wrap things up, Lynch discusses how the market can appear to have a mind of its own. For instance, when most investors expected stocks to decline dramatically after President Kennedy was shot, markets only dipped by 3% and astonishingly went up and also recovered within just 3 days. This incident, along with various other instances over time, is proof that the market can go in the opposite direction no matter what the fundamentals say. In the short term, markets are largely random and can at times be seemingly irrational, but with the right focus, Peter Lynch tells us that individual investors can earn what he calls a Tenbagger, which is a 10 times return on your money. And even better, we may have advantages to tap into that investment firms simply can't, because they're restricted in the types and sizes of companies they can invest in, on top of the fact that we may be tipped off on consumption trends well before they make their way to investor desks on Wall Street. That's it for this week, guys. I hope you enjoyed this video, and I'd really encourage you to check out the book for yourself. If you do, we have special links below to purchase a physical copy, or you can use our Audible link to listen to it. Please also like, subscribe, and share your comments below if you liked it. We love hearing your thoughts, so tell us, what are your biggest takeaways from this book? Do you believe that it's possible to have an investing advantage over the pros? And which books should we cover next? Just a reminder, nothing in this video is financial advice, and I'd encourage you to do your own research before making any investment decisions. For more Peter Lynch, listen to our We Study Billionaires podcast on him, and don't miss our mini-series on the ultimate guide to investing in stocks, where we teach you more about the fundamentals of investing, optimizing your returns, planning for retirement, and so much more. See y'all next time. Getting started is often the hardest part in investing, as stocks may invoke flashy Wall Street depictions that seem daunting. However, with this series, you'll learn what's necessary to not just beat the pros, but how to build a better financial future.